Okay. Hello everyone. I think this is live. So this is How to Invest, episode 8, and we are kind of starting earnings seasons for small caps, and it's quite an interesting period. So I'm going to talk about a few different things. There's a few things I wanted to highlight here. So the one thing that I think is quite interesting is to talk about how the overarching theme in our tech companies has been. The other thing that I wanted to highlight is that it's quite interesting to talk about behavioral finance. So I want to talk about a bit about behavioral finance. I also want to talk about overall thinking about I've got a few lists about, someone wrote to me about the thought process of how to think about investing and how to buy stocks. So there's a few things that I wanted to highlight, and yeah, so I'm going to just jump right in. One of the things that just wanted to briefly mention is that this is just for information purposes. Hello, hi, good morning, Taylor. This is just for information purposes or entertainment. Nothing that I say here should be taken as advice. So one of the things I just wanted to very briefly talk about, yeah, Miro, I see your question. I will answer that question. I do have it written down. That's one of the questions I've got written down. One of the things I want to just briefly talk about. So I just finished reading Michael Mauboussin's book about Think Twice. It's quite an interesting book. It's a bit like super forecasting. I don't know if everyone's read super forecasting. So if you think about super forecasting, thinking fast and slow, and if you think about Think Again by I think it's Adam Grant. If you look at those three and you think about Michael Maubossin's Think Twice, kind of the similar kind of idea that you have to take on an idea and kind of grip onto that idea, but as new information comes in you have to adapt it, so when new facts come in, I change my mind. So essentially there's a quote that he talks about in the book that this is studied, and at a supermarket they put either French music or German music, and it has a 70% predetermination on what the customer buys. So if you put French music in the background in the wine department, the customer is 70% likely to buy a French wine, and if you put German music, they're 70% likely to buy German wines. So although the majority of people acknowledge that there was some kind of French music or German music playing in the background, 86% denied that had any effect on them buying the French or the German wine. So I think it's quite interesting that we as human beings, we are primed in a certain way, and the first thing that we do is that we deny that we're primed, but we are, we're primed, we're creatures, and particularly right now in earnings season, there's a lot of volatility, and when share prices going up or down quite quickly, people feel that you have to act. Okay, everyone else is acting, so you have to act too. So this is not a good way to go about investing. Okay, you need to come up with a decision when you buy a stock, and I've said this many times before. If you've listened to any of my podcasts, or if you listen to any of my work, before you buy the stock, just write down 3 bullet points. Write it down physically, put it in the cloud so you got it with you. Write down 3 bullet points why you're buying a stock. Of one of those 3 bullet points has to include a valuation. So when the share price is down, let's say 15-20% on the day, go back to those bullet points and see if actually things have actually fundamentally shifted. More often than not, they have not, and the share price is down does not mean that you need to act. You don't need to go in and buy the dip. That's nonsense. Okay, the share price moving up or down is not a need for you to react. Okay, that's the first thing that I wanted to highlight. The second thing that I want to highlight is about buying on, like, when it feels good. Don't buy a stock because it feels good. Is that George Soros quote that if you're having fun investing, you're not making any money? Don't buy a stock because it feels good. Buy the business because the business makes sense. It's a business that's growing in intrinsic value. Okay, that's the reason to buy a business. Okay, and one more thing just before I go in and start answering the questions is that when you buy a business, you become the owner of that business. Once you become an owner of the business, you're much more likely to figure out more about that business over time. So you don't know a business, Apple reports, you don't know Apple until you're the shareholder of Apple, and then you start thinking about, everyone is talking about services. Do services actually matter? Yes and no. And you kind of think through that nuance, and it's that nuance that really makes you outperform. You know, if you're investing, you don't need to do you don't need huge returns. 15% is something that's quite reasonable to work towards, and you don't need to kind of have this impulse that someone else knows things. Okay, so I'm just going to answer. I've got a few things that I wanted to answer, but since the questions on the screen is why is PayPal down, I will address this question, and then if you have a question that interests you, be sure to put it down. So there's a few people on the call, which is great. I'm happy to see that people are showing up. So I'm going to talk about PayPal. So when PayPal talked about acquiring Pinterest, the stock plummeted because nobody wanted. Well, let me rephrase. Pinterest shareholders probably wouldn't have minded to have come out with that one. I don't know. But PayPal had absolutely no business to be getting involved with buying Pinterest, and the stock fell down. And what happens is that when the stock is falling down, is that kind of primal fear, and people are kind of, oh, I don't know, what shall I do? I don't know. I'm going to get out of this position. And when the stock starts falling down, it kind of triggers stop losses, and it's not down to the actual business underperforming significantly in the last 2 months or even the last 4 weeks. Nothing to do with that. It's just that investors are very much behavioral oriented, and they have this idea that things somehow have changed. Nothing has fundamentally changed this business. This is a business that, come hell or high water, is going to make approximately $5 billion of free cash flow this year. So if you think about it, right? So it's a business that is growing. Okay, so once eBay has left PayPal, which happens now in Q3, and to a certain extent some remains in Q4, but starting in earnest in 2022, this business is going to be growing at approximately 20 to 25% compounded annual. So it's a business that's growing approximately 25%. It's highly free cash flow generative, and they have shown a history of repurchasing their shares. So there is no need to kind of think about, oh, the stock is down now, is it going to come back by the end of the next month? More likely than not, in 6 months' time, you'll be back to where it was, and more likely than not, it's probably even going to be higher. And if you think about, I always try and think about where the business is going to be over the next 2-3 years. Over the next 2-3 years, it's undoubtedly that PayPal will be higher, and it's important to kind of understand, the dynamics that happen. But it's also important to say, in the grand scheme of things, if the stock is slightly down like 20% in a short period of time, it's more likely that it's just behavior, and I don't think that you should be kind of overwhelmed by that. I'm not sure, Miro, if that answers your question. If I have not sufficiently answered your question, please drop it in the comments or get in touch with me, and I'll do my best to kind of try and address it in a better way. Did one more thing. So the general advice is to keep a watch list ready. With earnings seasons, dips and market sell-off, it seems a good time to buy off the watch list, but it feels uncomfortably to buy it so quickly. Yeah, so this is what I say, like in pretty much all my videos. Everything that you do about buying a stock is in the preparation to buying the stock. So you need to do the work. It's like I always talk about the Olympiad, because the Olympiad doesn't kind of figure out on a day when he shows up or she shows up to run the race. It's the preparation in the advance. So it's the 10 years before that, every single day doing the work. Now you don't need to kind of run a race, and like, it's not the same kind of thing, but you do need to do the preparation to have a very good understanding of a few names on your watch list. So my portfolio holds about 15 stocks, and I follow many companies, and I've got space in my mind for many companies, but there's only like 2, sometimes nothing really, 2 companies or even nothing that is really compelling to me on my watch list. The watch list shouldn't include things that kind of, like I talked at the beginning, that kind of feel good. Don't go for things that feel good. Go for businesses that you want to own. You want to own those businesses that really you can see over the next 5 years or so will be much stronger, much more compelling businesses. Do not kind of, for example, think about, okay, oh, I like XYZ, I don't know, like a cannabis stock, like, because everyone else likes cannabis stocks, and I'll put it on my watch list. Be very, very thorough and be very, very thoughtful and responsible when it comes to putting something on the watch list, because I always think about, like, investing is just about numbers, but what we're trying to do is trying to kind of make our lives better for our families. That's what it's about, right? So we're trying to kind of compound our portfolio higher to really improve the quality of our family's life. And it's kind of like doing the work, right? It's like when you go to the gym, you do have to kind of be quite disciplined there. You kind of go in and you put your timer, and you go to failure, and you have to be quite disciplined and mindful of every single repetition that you do. And it's the same thing about putting stocks on your watch list. You have to kind of be quite thinkful. Do I actually want to spend the time trying to figure out this business? Because ultimately you only have a certain amount of time in a day, and you haven't got the mental space to kind of know, let's say, 30 businesses. So you don't react necessarily when the stock is up or down. That is not a reason to react. That is not a reason to invest. But if you've done the work and it seems like the valuation makes sense at that time, that could be a reason for you to put 1.5% of your portfolio down and get to know the business over the next, let's say, 8 weeks or so. You read a bit more, and the universe has a way of kind of bringing to you more information. Then you put down, let's say, another 1.5, so you're approximately 3%, and then you go through the next earnings season, and then you add, let's say, another 3% or so. So at that point, you're kind of around 5 or 6% of your portfolio. At that point, things start getting kind of interesting. As I said before, I have only 15 stocks in my portfolio, so each one is, if you think about it, it's quite heavily weighted. So do just think about that as well. When I talk about my weightings, if you have, let's say, 30 stocks, your weighting is going to be much lower, but just make it proportional to that. It's just food for thought. So I have a large loss in Alibaba. I'm not a huge fan of Alibaba. I know that some people are, and I own Pinduoduo. Someone wrote to me that I kind of say this really badly, PDD. So I just want to say so Alibaba's accounting is a bit like Salesforce in a way, or even like Shopify, where depending on how many acquisitions they're making and they do the mark-to-market accounting, it changes how it reflects in the financials. It's difficult because it's difficult to get a real sense of how many zillion businesses there is underneath Alibaba. It's quite difficult to have a real big grasp. That being said, I know that Charlie Munger is a huge fan of Alibaba. Li Lu, obviously everyone knows, is a huge bull when it comes to Alibaba. I don't know. So this question about Alibaba, I mean, I'm not averse to owning a Chinese company. As I said, I own PDD. Which is Pinduoduo. Someone mocked me about that I mispronounced it. But essentially, I'm not averse to investing in China, but I just want to say that be careful, okay? Don't put too much of your portfolio into China. Do by all means consider, for example, Europe. There are plenty of very strong businesses in, let's say, in Poland, that, like, for example, everyone follows Twilio. I don't know if anyone saw that Twilio was down approximately 12%, I think, on the back of their earnings report. There's a company called Live Chat, I think it's all one word, Live Chat in Poland, that's growing at a reasonable rate. It's highly profitable, and it does pretty much the same as what Twilio does. So just kind of think through that. Don't only invest in China, do consider as well, if you want exposure to that, there are other places as well that are quite interesting. Go for like reasonably big caps in other countries as well if you're interested in that. Okay, so about lending company versus Upstart. Oh, thank you for writing me, Rob. My question is this: if the stock goes up quite a bit, like Upstart, what are your thoughts of continuing to hold versus investing the profit? So whenever I've made an investment, my thought process is this: I am looking for the re-rating, the change in sentiment. Okay, so I'm wanting to buy the higher quality business as possible at a valuation that I believe that over the next, let's say, 2 years, the stock will re-rate higher, the multiple will expand. Okay, and I'm using my experience of following many companies to say, okay, this is kind of like, yeah, as I knew that someone's going to mock me about how to pronounce this. Yeah, I can't even talk English, so don't worry about it. Yeah, so when it comes to buying a stock, I'm looking for this double margin safety. So I'm looking for the business to continue to grow at a reasonable rate, and I'm looking for the sentiment to change and the multiple to expand. So that's what I call like the double margin safety, because even if, for example, investors don't come around to seeing the businesses as I do, because it's been growing over the next like 2 years or so, you kind of get some margin safety that you don't lose a lot of capital because the business is still growing. So even if the multiples stay the same, you're still kind of gonna get rewarded to a certain extent. So in the case of Upstart, I'm just looking to kind of wait around. I like to own a business for a year at least. It's a reasonably newish investment to myself. I think I've only owned it for about a quarter or so. So it's quite a new investment. So I don't like to exit a position before a year. After a year, it's a different story, and we can reassess how things look. But I don't want to kind of take away from Upstart because there's a quote from Warren Buffett that says that, or even a better one from Peter Lynch, that if I end up plucking all the roses, I end up with a garden full of weeds. And it's one of the best performers in my portfolio, and I'm not going to punish that position just because it happens to have worked out. That's in investing. In the ideal scenario, when you invest, you kind of get everything working out up and to the right. But in reality, you're kind of going to be really lucky within the 5 positions if you get 2 that work out really well for you. And if you happen to have worked out quite well for you, don't be too quick to take profits off the table, because you don't know like how the business is going to do over the next year. Maybe at the moment the stock is priced at approximately 23 times forward sales, okay? But let's say that by next year it grows a bit faster than analysts expected. So analysts expecting it to grow at approximately 35% next year. Let's say it ends up, for the sake of discussion, growing at 45%. So the multiple in that event, it probably still stays quite low, around 23%, 23 times forward sales. So there are plenty of growth companies out there that are growing at 40% and being priced at, let's say, 50 times sales, and they have no profits to even talk about. This is a company that's highly profitable. So I don't want to be an idiot. I know that it's rallied a lot and stuff like that, but I don't want to take out my capital out of that business because it's doing well. One more thing I wanted to say. In investing, in your ideal scenarios where you put $1 down and the business compounds that earning or that dollar over time. So for example, let's say that you're Bill Miller in 2002 and you bought Amazon, and Amazon has done terrifically well for you. If you were to just dump Amazon because it's doing too well for you, you'd end up with all the kind of suboptimal results of the rest of the stocks, and you'd be no one even talking about you. But if you're lucky enough to kind of hold on to a business for some time, I'm not saying indefinitely, I'm saying just for a little bit, and not to be too kind of anxious. That's a lot of things that when I've seen in investing, people have this kind of urge to react when the stock is down or up, let's say 15 to 20% or even 30% or a bit more than that they have to do something. Now in investing, if you think about like a standard deviation curve, kind of you got the middle, that's like the peak in the at the top, and then you got the tail ends, and the tail ends is really what drives the portfolio higher. And if you are exiting out of a position too quickly, you're not allowing for that right tail movement to drive your whole portfolio forward. So in plain English, if you're lucky enough to see your stock go up 100 or 150%, let it compound, even if something happens really badly with Upstart. And let's say, for example, that the stock falls tomorrow by 50%, you more likely than not have still made some gains. So even if the stock is down, the point of investing is not to lose capital, right? So if you invest in the stock Upstart falls by 50% tomorrow morning, you still not lost any capital. You can continue playing this game. That's the point of investing. Buffett's rule number 1 is not to lose capital. You just want to stay in that game. You want to stay performing for as long as possible. I see the question about Twilio. So Yeah, it's complicated with Twilio. So a lot of these SaaS companies did quite well in 2020. And as we look right now, the market is starting to discern, is this SaaS business worthwhile investing in or not? So I'll give you an example. So I don't own any position in Asana, okay? But the market is paying a really high multiple for that because they believe that relative to, let's say, Monday.com or Smartsheet, that will be the dominant productivity platform. So they're paying a very high multiple for that. In the case of Twilio, people are saying maybe not. There could be another competitor like Bandwidth, or there could be, we already came up, live chat, or it could be Agora. Not Agora is quite a crappy business, but it's just the point I'm trying to make is that the market is like, do I really want to be continuing to incur in these losses with Twilio? Because if you look at Twilio's path to profitability, I mean, they're not getting any positive operating leverage from their acquisitions. You can see that they've been really acquisitive in the last 18 months, and they're not being able to translate that into steady profitability profile. It's just been really kind of moving in the wrong direction. So I don't know is the short answer to that. I'm so grateful I don't have to make that decision because it's a tough one. I just wanted to highlight something that someone came in. Someone asked me if I could compress to me my thought process when I buy a stock. So I'm just going to go very quickly through 6 points that I've written down. I'm going to try and compress for you 10 years worth of research into 2 minutes. Okay, I'll try my best. Okay, the first thing. So yeah, I can answer about Atlassian in a minute. Just one thing. So I'll just very briefly. Whenever you look at a company for the first time, either pick up the S1 filing, that's when they do the IPO, or look at the 10K, okay? If the business is new, you look at the S1. If the business has been around for some time, look at the 10K, okay? When you look for the 10K, try and understand what the business does, first and foremost. Just try and get a grasp of that. The next thing that I do, go on the investment risks. Typically, investment risk number 3 is the company telling you, for real, what is actually the biggest risk the company faces. The first 2 are kind of just nonsense, but starting point 3 and point 4, they talk to you about the serious risk because the company knows, right? They know what their risk, they know their competitors, they know what's the risk that they're facing. So look at the investment risks. Try to just get a grasp. Okay, is this something that I'm going to be comfortable with? Like they say, for example, that in the case of Upstart, the customer concentration is very high. Are you going to be comfortable with that or not? You have to think through that. Okay, so that's one thing that I wanted to say. Next, look point number 3. Look at the past 3 years of the financials at least. Even if it's a new company, they'll give you 3 years of financials. Look at that. Try to find businesses that are stable and growing. Okay, so you don't want, like, say, the business to be growing at 50%, then 5%, then 20%. It's too unpredictable. You're not going to be able to have an ability to quantify where our business is going to be over the next 5 years. I'm just trying to give you kind of easy rules of thumb because, for every one of these there's an exception. You can look at the GameStop, and you can just look at these abnormalities and say, it doesn't always work. I know it doesn't always work, but just some quick rules of thumb. Read through the last 4 quarters of earning calls. You can look at that on either Seeking Alpha or somewhere else, and just read through that and see what the analysts were asking at the bottom of each earnings call. Look through and see what analysts were asking, see what the common thread is, and then fast forward to the next quarter, read through that, because management will be trying to address in the next quarter what analysts were asking this quarter. So try to get a feel for what's the nuance there, what's happening really with the business, because the analyst calls are very, very important. That's really the only time that management kind of goes off script, if you will, and gives you a sense of where the business is really going well or not going so well. So spend some time there. 2 more things. Compare with the peers, okay? So look to see how the closest tradable peer is doing, okay? If all the tradable peers are doing badly but your company is doing well, that's great. It shows that you probably chosen the better one. If everyone is doing well, spend a few moments and think through, maybe I've looked at ABC, but maybe the next peer is actually slightly better, and don't necessarily be put off because the share price is down or up. Just think through, just have a bit of thought process, because oftentimes I've looked at one business and I'm like, okay, that's interesting, and like just by doing like some kind of checks to the peers, I say actually that other business is a lot better. So just spend a bit of time on that. And the last thing, have a bit of thought process in the valuation of the business. Okay, don't go for something as I say price at 50 times forward sales, because it doesn't leave you a lot of room. If the multiple contracts, it's going to be nasty. It may not contract. You look at for example Tesla, it never contracts at multiple. You look at Shopify, it never contracts. So don't necessarily be put off just because the multiple going in is high, but just have a bit of thought process. Am I going to get enough margin of safety here if things turn sour? I can look in hindsight and tell you that all like these companies like Netflix, whatever, have been tremendous investments, but going through those periods when the stock is down 50% and you've overpaid is going to be difficult. So looking in hindsight is helpful, but it's not everything to investing. So just think through that a little bit. Look at the valuation, because if you're paying 50 times forward sales, it means that you are estimating that the company can continue at this path for the next 50 years, which is totally unpredictable. Okay, so just some nuance is what I wanted to point out. So Rob is asking me about Atlassian. So Atlassian is doing great. It's one of those few businesses in this productivity space that is highly free cash flow generative. Okay, I don't know how they are so free cash flow generative, but they are. They make a lot of free cash flow. That being said, the stock is expensive, and I have been quite bearish in the past with Atlassian. I've been kind of like, oh, I think it's too expensive. And for more than 3 years, I've been saying it's too expensive. And I said, okay, maybe I'm the one that's wrong, and this stock is not as expensive as I felt, because I can see that they made approximately, off the top of my head, 40% free cash flow margin over the last fiscal year. So that means that for every dollar that they've made in revenues, 40 cents have come out as free cash flow for the business. So it's incredibly asset light. So perhaps it is warranted a higher valuation. I would not personally get involved with it. I mean, I missed that boat, but it doesn't matter if you missed the boat, because there's always tomorrow morning or next week, there's always some kind of new opportunity that shows up in your doorstep. It's much more important for you to kind of spend some time, as we talked with Taylor at the start. It's much more better for you to start and think through the watch list and build that, rather than chasing something that seems quite attractive. I think we kind of wrapped up here with the questions. Does anyone want to drop me a question just before we wrap up? It's been great to see so many people here with us on the call today. It's been really rewarding. If anyone wants to kind of ask any more questions, please feel free to kind of drop me a question. It's been really terrific to have everyone here. I hope you stick around for next week, because next week is it's the earnings season, and it's going to be very, very exciting, because particularly small caps that get reported. A lot of my businesses that get reported next week, so it's going to be really crazy for me. It's going to be a lack of sleep, I suspect, the next week, because it's just going to be so much stress. But yeah, I hope that you'll stick around for next week, because next week's, it's going to be really telling. One more thing that I want to highlight just very, very briefly. Next week, when they start reporting the smaller caps, I think it's going to be quite insightful for how the market is going to be operating, because for now, growth has been kind of, since the start of, let's say, September, growth has been really, really growing quite significantly. The market has been really, really welcoming that, but we're going to see whether the market sentiment has been overextended relative to how these companies are performing. So here's my takeaway. So if the next 2 weeks the market is not kind of selling off too much, that means the market has been quite happy with the results. That means that, if you want to position your portfolio slightly more towards growth stocks, I think that could be something worthwhile to think about. That being said, if the market over the next 2 weeks really tanks, that means the earnings results didn't live up to expectations. That means, we're going to have probably a value rotation again. As always, thank you very much, everyone. I really appreciate everyone on the call.